Having $20,000 in your account doesn't change your internal perception of finance.
That amount changes how every financial institution in the United States is legally, structurally, and algorithmically set up to interact with you. There's a Federal Reserve working paper from 2023 that categorizes households on a scale from financially vulnerable to financially resilient. The cutoff economists use isn't 50 or 30, but $20,000 in liquid savings.
And here's the part that doesn't usually make the headlines.
Banks use internal models of customer profitability, and there's a special definition for people below the threshold.
They're called highly engaged accounts.
In corporate parlance, that means they're charged the highest fees.
Your bank doesn't want you to go completely broke, because broke people can't pay at all. A lender needs you to be almost okay.
Just tight enough to occasionally overdraw, and just anxious enough to never give up on banking products.
$20,000 is the precise number that destroys this business model.
Today, I'll demonstrate exactly how these mechanisms work, why they target your income range with surgical precision, and how the mathematics of life changes once you cross that threshold. We'll examine 5 specific ways banks extract funds from people with savings under $20,000.
Then, I'll show how reaching that amount changes the balance of power in any financial relationship.
Not just with the bank, but also with your employer, landlord, and anyone else who needs your consent. Finally, I'll present a detailed scenario with real numbers, because financial content often avoids specific calculations when they become inconvenient. Before we get into the details, let me offer a metaphor to help you understand the situation better.
Think of your bank as a toll road.
It's not a modern state highway with clear rules, but a private road from the 19th century. Back then, a company could own a single bridge across a river and set any price because the alternative was swimming in icy water. The bridge owner didn't want you to get rich, but he also didn't want you to fail completely. He wanted you to remain productive enough to earn money, but still need to cross it.
Every month, you paid your toll. $20,000 is the moment you build your own bridge. Once that happens, the toll road owner loses control over you forever. Now let's look at how the profit-making model is designed for those with balances below $20,000. The first level is overdraft fees.
In 2022, according to the Consumer Financial Protection Bureau, American banks collected $7.7 billion in overdraft and non-sufficient funds fees. But what's striking is that 9% of account holders paid 79% of this amount. The remaining 91% of customers contributed virtually nothing to this revenue stream. The bank didn't cast a wide net, it targeted a specific demographic with a specific level of financial stress.
This is achieved through transaction prioritization algorithms.
When you have several pending transactions and your balance goes into negative balance, the bank can process them in any order.
Some institutions intentionally process the largest transaction first, so that the maximum number of smaller payments will also trigger overdrafts and penalties.
Wells Fargo Bank paid $1.4 billion to settle a class action lawsuit precisely because of this practice. This isn't a technical glitch, but a conscious decision made during a product meeting. A toll road doesn't just take money from you, it chooses the most advantageous moment to charge you.
When you have $20,000, you never go into the red. The algorithm simply has no entry point into your life. The second level is credit card interest.
Federal Reserve data for 2024 shows that the average household with debt pays about $1,300 in interest per year. Rates at the beginning of 2026 ranged from 22 to 29% per annum. These amounts are mostly paid by those without a financial cushion.
A credit card becomes their default emergency fund. If your car breaks down or you get a dentist bill, the card takes the hit.
But since the emergency has consumed the next month's surplus, you can't pay off the bill.
The industry classifies cardholders.
Those who are constantly in debt and paying interest are called revolvers. Those who pay off their balances completely and don't generate interest income are called transactionists. But in industry publications and at internal conferences, they use a different term for these people: slackers.
A person who uses points and cashback but doesn't earn anything is considered useless to the system.
Your goal is to become just such a slacker.
The third tier is the account maintenance fee. Research from 2025 shows that the average monthly fee is between $15 and $18. Banks waive this fee if you maintain a minimum balance, usually between $1,500 and $5,000. The mechanism is simple. If you're just starting to save and have a bad month with unexpected expenses, your balance drops below the threshold. And right when you're struggling most, the bank waives the fee. This isn't a penalty for irresponsibility, but a price for financial vulnerability at a particular moment in time. The fourth level is the desperation premium. Research by the National Bureau of Economic Research has confirmed that borrowers under financial stress pay 1 to 2 percentage points more on loans than stable borrowers with the same credit score. For example, on a $30,000 car loan for 60 months, an extra 2% would cost you approximately $1,600. This is the price of a weak negotiating position. Lenders sense when you can't afford to walk away without a deal. Having $20,000 gives you an alternative path, and once the bank understands this, the cost to you is reduced. The fifth level is the psychological tax. It doesn't show up on statements, but it can be the most expensive. In 2013, researchers from Harvard and Princeton measured the impact of financial stress on cognitive abilities. The results showed that money anxiety reduces brain performance by 13 IQ points. By comparison, a full night without sleep degrades brain function by 8 points. Chronic financial stress is more destructive than sleep deprivation, and it doesn't subside with rest, pulsing in the background every day. This leads to measurable consequences. Stressed people are more likely to make impulsive purchases to get a short-term rush of dopamine and relieve anxiety. They settle for worse terms because their cognitive resources are depleted, and carefully comparing options requires energy they don't have. Companies that profit from such people didn't create this stress, but they factor it into their pricing. $20,000 is the level at which anxiety becomes manageable. Those 13 intelligence points return, the ability to compare options and think about the future, not just tomorrow, emerges. Most financial advice ends with the phrase $20,000 is an emergency fund. But few explain how this number changes your relationship in any negotiation. Consider the story of a woman named Claire. She had worked in marketing in Atlanta for 8 years, was an excellent professional, but her boss constantly took credit for her accomplishments and ignored her requests for a raise. Claire saw the injustice but continued working, as she had only $6,000 in savings, a mortgage, and a child. Her boss had leverage, he knew she couldn't afford the risk. When Claire inherited $18,000, her total savings were $24,000. Within 90 days, she applied to other companies, received 2 offers, and quit. Her parting offer was a 23% raise, but she declined because the new role offered better prospects. Claire didn't become braver or gain any new skills in those 3 months. She simply stopped being desperate. In behavioral economics, this is called external option value. When you have a real option to leave, the value of any negotiation increases. Those around you feel a sense of exclusion. Without $20,000, any threat of dismissal is a bluff. With it, it's a reality that changes the entire dynamic. Recall any major purchase made under time pressure. Your negotiating power was close to zero. $20,000 doesn't eliminate urgent decisions, but it does remove the most common source of haste, a lack of cash here and now. The toll road loses its power because you have an alternative route. A former bank branch manager named Derek told me that they tracked clients by margins. The most profitable weren't millionaires. Rich people hardly use retail banking services. Ideally, a bank's client is someone with an income of $50,000 to $80,000 per year, a small amount of card debt, occasional overdrafts, and savings of less than $20,000. Such a client is reliable and consistently pays a fee. Later, when bank policies began to change under pressure from regulators, Derek's branch, where clients had more savings, became considered exemplary. It turned out that the long-term value of a client with more than $20,000 is higher, as they use complex products for decades, rather than simply generating one-time fees. Let's look at real numbers using Ryan as an example. He's 34 years old, with an after-tax income of $68,000 per year. or $4,400 per month. His expenses are $3,700. In a good month, he has $700 left over, in a bad month, zero. His savings are stuck at $4,000. Ryan decides to change his approach. He opens a high-yield account at another bank and sets up an automatic transfer of $500 on payday. After 20 months, his savings reach $20,000. Here's what immediately changes: his credit utilization drops from 42% to 9%, since he no longer needs to borrow money until payday. His credit score rises 31 points in 2 months. He refinances his car loan, lowering the rate by 1.9%, saving him $1,240. He increases his insurance deductible, lowering his monthly payment by $61. Now Ryan saves $850 a month instead of $500, without receiving a raise. The $20,000 leverage did all the work for him. The financial advice industry often benefits from complexity. You're offered a multitude of strategies and products with fees around 1%. But if you have $9,000, that 1% fee will eat into a significant portion of your profits. The simple way is often more effective. First, build a $20,000 buffer in a high-yield account. Then, funnel the excess into a low-cost index fund. The S&P 500 has grown at an average annual rate of 10% over the past 30 years. $100,000 invested for 35 years and left until 65 will turn into approximately $1,749,000. This is the result of patience and compound interest, which only becomes available when you stop fearing emergencies. Here are 3 concrete steps you can take. First, calculate your withdrawal rate for the past year. Add up all overdraft fees, account maintenance fees, and credit card interest. Add in any overpayments on loans due to unfavorable terms. For most people with less than $20,000 in savings, this amounts to between $1,200 and $3,000 per year. This is the net cost of not having money. Second, open a high-yield savings account at an institution other than your main bank. This will create the necessary psychological barrier. If money is available at the click of a button, it's easier to spend. A transfer taking 2 or 3 days gives you time to think things over. At the start of 2026, such accounts earn 4 to 5% per annum, while regular accounts earned around 0.2%. On a $20,000 account, that difference amounts to hundreds of dollars per year. Third, evaluate your external option value. How many months could you survive without borrowing if your income disappeared? If less than 3 months, your position in any negotiation is a bluff. $20,000 provides 3 to 4 months of peace of mind for the average family, turning a bluff into a strong position. The financial industry prefers you never cross the threshold. Wealth accumulation is a tedious and time-consuming process that begins with one crucial number. The toll road still exists, it's optimized, and waiting for customers. Your task is to build your bridge, cross to the other side, and never pay a toll again.